So if you think about cash and liquidity, every organization, whether it's a bank or a corporate, needs to manage its cash rather effectively. And banks' treasury has traditionally been very active in monitoring and managing that liquidity. That has become a bit more important in the current state of regulation. Regulations have been hammering down majority of the banks. If you look at the Basel regulations coming down the line, or have been in effect, they have been looking at saying, make sure you have stable funding in place, your liquidity coverage ratio is in order. Now, more and more, the regulatory authorities in the UK, the PRA, is asking banks here to monitor their liquidity on an intraday basis. Now, that has started some time ago. They've been reporting on it, they've been monitoring it. The next phase of that is, how do you actively manage intraday liquidity?
With regards to distributed ledger technology, we have been actually exploring this technology and using this technology for the last 4 years. We have delivered until now 44 proof of concepts, together with 7 pilots in production. And we are focusing obviously on bringing this technology and deploying the technology for the benefits to ING and also to our clients. Actually, we have been doing several pilots, including clients within, a specific value chain, like for example in the areas of payments, in the areas of trade finance, in the areas of post-trade and financial markets. And what we have seen is actually a benefit in terms of, you have more real-time access to information, you have newly available data, and that also enhances, for example, the liquidity for our clients, and sometimes, reduces the capital that they might have. You are making items or actually tokens or specific assets more liquid, which also helps our clients to manage better, their collateral, the liquidity, and some of those requirements.
The more you manage your liquidity on an intraday basis, it's more likely that you will not be impacted by the cost of short-term borrowing at the last minute. So think about it. If you've been looking at your liquidity and you're not managing your liquidity on an intraday basis, you plan your liquidity needs based on the internal cash flows that your system is showing, and then say by 3 o'clock, when the market is fairly liquid, you square up your position. Guess what? Last minute at 4 o'clock, trade finance team says, I need to make a settlement for an oil transaction. 50 million needs to go out. You need to borrow that money on a very short-term basis, and that you're going to end up paying higher cost of borrowing. So that's one part of it. The second part of it is, so that becomes more of an active business requirement, right? The second part of it is that if you are not actively monitoring that liquidity, and then you have this sudden peak that comes up and you start reporting it, in fact, you have to report it to the regulator. The regulator says, well, that's happening on a regular basis that you're not actively monitoring. Guess what? You need to put a bigger buffer of capital against your liquidity needs. There's a cost associated with that. So from the regulation, which was ticking the box exercise, to active management of liquidity, has a bottom line effect.
I mean, the challenges in running a real-time payment system come in a couple of areas. One is the infrastructure that's required to run 24/7. Second is the liquidity to be able to move money that quickly. So someone has money in their bank account, do we have enough money? How do we move that kind of situation?
One of the things that I'm hearing more from banks themselves is the integrating the underlying customer requirements to the bank's treasury requirements. Intraday liquidity has a cost. Banks are absorbing that cost.